Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, April 5th, 4:58 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market in an uptrend taking a little bit of pressure over the last couple of days. And we have been commenting about how we were excluding real estate and financials from anything we'd be focused on this uptrend. We're adding industrials into that. In fact, we talked about that in last night's video. The recent recessionary data that has come out uh, has seen a lot of sector rotation away from inflation, sorry, not inflation, recession, uh, sectors that was recession susceptible. That's kind of a mouthful. Sectors, and we saw that continuing again today. Let's check over here on the trend gauge. Market leaders, some of them hit today, some of them held up pretty well. The subject of tonight's video, strength is revealed in the pullback. We'll dive into what survived and what took it on the chin. Short term, uh, coming into the week, all five the major indexes were above the 21-day moving average. Continued weakness in mid caps and small caps. Again, with a focus on what's going on with the banks. Uh, Still in an uptrend because the big cap stocks are holding. The big cap indexes, the S&P 500, the Nasdaq 100, and the Dow Jones Industrial Average are still holding up strong above their 21-day moving average. Neutral on the medium term. Again, we've got the S&P, Nasdaq, and the Dow above the 50-day moving average. The small caps below the 50, small caps and mid caps also below their 200, while the big cap indexes are holding up. So really, it was already a bifurcated market with what's going on with the banks. That's gotten a little bit more bifurcated this week as what happened today continued rotation. The rotation today hit growth leaders. Now, if you look at a chart of the NASDAQ 100, which we will in a minute, that's what immediately comes to my mind when I hear growth leaders. That looks fine. Pull back a percent. Really, the chart, no damage done to the chart. Was more with the mid caps and recent leaders. Some broke below the 21. Some finished the day okay, undercut and reclaimed the 21. But this rotation, it seems more that some of the babies are going out with the bathwater as this continued uh, bad economic data that's pointing to a recession is starting to take the forefront in what's going on in the markets. That's why staples and medical stocks have been the strongest lately. Industrials extremely weak, financials weak because of what's going on with the banks. They just can't get their footing. Same issue with real estate. And XLK, which is dominated by big caps, tech, that's holding up okay. In fact, we're going to go through the indexes again. And here are the numbers on the day. RG7. Days like today are exactly why we do two things. One, we created the RG7 to uh, point out the fact that growth leaders are not holding up well relative to the rest of the market. The worst today was ARK-K. Every one of the ARK leaders was down fairly significantly. Uh, that was the worst. The other six components really not all that bad. But yesterday, the ARK-K held up this index, but just the opposite today. Mine down 1.4% on the day. S&P 500 gap down at the open by 0.2%. Sold off. Uh, Made a low late morning, and then attempted to bounce. And any sell-offs after that, buyers showed up, and it actually ended up being a fairly decent close, only down 0.25% on the day. NASDAQ 100, same thing, but a little bit worse with the numbers being down 1% on the day. Dow, no surprise, when the market gets defensive, money flows into the Dow, up 0.24% on the day. Mid cap, which is ironic because obviously, you've got the Dow Jones Industrial Average, but some of the heavier price stocks holding up the Dow. UNH up nicely again today. That's the highest price stock in there. The Dow up 0.24%. Mid caps down zero point 0.7, Russell 2000 down 1%, Global Diversified 60/40 down 0.21%. We talked last night about how it might be time for bonds, and we took some action on that today. And bond prices again up on the day, meaning yields down, and appearing to be two things. One, a reflection of the fact that the continued weak economic data points to the fact that the Fed may need to be done raising interest rates, and two, a flight to safety. If there are if people start getting fearful, they go not only to the lower beta sectors, lower volatility sectors, defensive sectors, they also go into bonds. In-house GROTECTION down 1.27% today. Our biggest holding, ONON, got a downgrade, and we got stopped out on the entire position. Booked a nice gain on it, especially relative to what the market did over the same holding period, but stops are stops. We've kind of run into, for the second straight day, a little bit of a streak of bad luck between uh, a short seller coming out attacking the financials of one of our owners, holdings, one of our biggest holdings, First Solar, getting downgraded twice. But stops are stops. It's part of the game. One day of underperformance doesn't make or break the year. And we've been in this long enough to know that when the market is in our favor, we'll press the pedal down. It appeared that it was late last week. Uh, then the inflation data came out, and we have to change. We have to pull back a little bit, and we do what we need to do to protect the downside and to stay focused on what's working. So let's dive into the charts. We'll start off with the S&P 500 as we always do, and there's nothing at all wrong with this chart. We're in a rising channel. We break below the declining trend line of that channel, that'll tell us something. But for right now, a normal pullback after the move that we've had off the lows is uh, this looks fine. And this is another reason why we focus on the S&P 500 as the ballast for our portfolio. When rotation takes place between growth and value and between sectors, it all occurs within the S&P 500. This is why it's difficult for a lot of fund managers to beat the S&P 500, because the rotation is constantly taking place. It's a very diversified index, and as long as it is in an uptrend, that's where we want to have at least zero point 0.6 beta, which is the equivalent of a 60/40 portfolio if the 60% was all the S&P 500. And that's where we are today. The other 40% we have now in 25% in short-term bonds, 15% in long-term bonds, the TLT. Actually, TMF is what we bought today. It's an enhanced TLT. So, and then remaining is growth stocks to add alpha when they're acting well, and they were up until last Friday. A little bit came off the last couple of days. Today hit harder than we'd like to see, in addition to a little bit of the bad luck with downgrades that we saw. But it is what it is. We don't hide. We do these videos every night, and we'll take a look at the charts and talk about our portfolio changes and why we did them when we get to the tail of the tape. So there's the S&P 500. Let's go to the NASDAQ 100. Again, you think growth leaders getting hit hard. Yeah, it's down 1%, but we're just sitting on the ADMA. The breakout still intact above 313.68. We undercut and closed right at a key fib above 315. Nothing wrong with this chart. And when you worry about uh, in rising interest rates and a recessionary environment, when you look to some of the big cap stocks that are holding up just fine, that's a place to park some money. I'm talking about stocks like Apple, Microsoft. Um, they make up the majority of the XLK, the tech sector, and that's reflected in the chart as those are holding up just fine for the time being. If that changes, will change. Let's go next to the Dow Jones Industrial Average. Again, money flowing into this inside day, tight range, up 0.25% on the day. Nice relative strength over the last 3 sessions, as you can see here. And this is coming off of a pretty serious underperformance by the Dow. But when these things, and then that came after a massive outperformance in September and October by the Dow. These trends with the Dow The Dow doesn't move in a straight line. It underperforms and outperforms significantly at various times, and you can see that based on the relative strength line for when it's time to be risk off and when it's time to be risk on. So there's the Dow. Let's go to mid caps now. Continued weakness here. Closed near the top of the range. So that says that after 3 down days, we may be time to go stop going down. So that makes today's low somewhat significant. We did close below the 200-day moving average, and our second close below the 21-day moving average on the negative side. Small caps, again, second close below the 21, closed mid-range on the day. And the banks, today banks closed mid-range, but they still are continuing to cause some trouble. And we had some negative comments by Jamie Dimon saying that the bank crisis isn't over. That took us down on the financials midday today. So that is the five major indexes. We'll take a look at the sectors when we get into the tail of the tape. Let's flip now to some other inter-asset correlation. The UUP, the dollar up on the day, uh, still trending lower. This is a favorable setup, but we are oversold. Next up is the VIX. VIX really didn't move much at all today. Uh, by the end of the day, it was up higher. As we gained some strength, we came down on the VIX toward the end of the day. So it closed slightly higher than yesterday, but not by much. Still declining, still below that 20 level and the declining 21-day moving average. Now let's flip to bonds. We talked last night about getting involved in these, and we did see a little bit of a breakout in the TLT today. TMF is what we bought. It's 3 times the TLT. We'll manage it using the underlying chart of TLT and the return on the 30-year bond, the TYX. We can see TLT breaking out here. Let's go to the 10-year ETF. Uh, Also breaking out, closed near the low of its range on the day, but you can see the trend of the prices in bonds going up. That means the yields going down. That's the market trying to say the Fed possibly needs to be done with the recessionary data that's been coming out lately. Let's go to LQD, corporate bonds, also up on the day, and BND, the broad bond index, also up on the day, although finishing at the bottom of its range. Junk bonds, JNK, down on the day for the third straight day. And again, this kind of stays in line with the recessionary data that's coming out. Will companies be able to pay their bond uh, paid their bond rates, especially on the higher yield ones, companies that don't have a credit rating high as AAA corporate bonds or highly rated corporate bonds, but investment grade corporate bonds is what I'm trying to say. But junk bonds down again on the day after a pretty strong 3-day up move. The question is, was that up move a head fake, and is it going to get completely undone? Are we going to rotate a little bit and then settle in, or is there going to be massive rotation? I would expect continued rotation if continued weak data comes out until we get something decisive either way from the Fed, but that's a month away. Let's flip to gold and silver. Dollar up on the day. You would expect precious metals not to do much. Just consolidating in a tight range today is GLD, GDX, slightly higher on the day. This has really been a nice uh, trend above just riding the ADMA higher. And silver SLV down slightly on the day, but closing at the top of its range. Bitcoin, Bitcoin flat on the day, continues to consolidate. So those are the major inter-asset charts that we look at. Let's go to the tail of the tape now. You can pause it here if you want to read the whole thing. The stochastics have worsened on the broad indexes. It's a mixed bag, but the big caps are oversold and started to roll down, but they're overbought and started to roll down. On the 60-minute, however, they're oversold. So that should give us a little bit of a bounce before we make a decision as to whether or not this is going to continue to go down or not. G6, not acting well at all this week. That's now negative. The NASI RSI still in a positive posture, as is the US dollar. Uh, Bonds making after that island top, now bonds making new lows. I didn't go to the actual yields. Here's the 30-year yield. You can see the breakdown making new lows, and the 10-year yield, the TNX, making new lows also very clearly. Again, market trying to tell the Fed to put the brakes on. Um, Two other charts I want to show. For a while early in the year, we had been talking about the divergence between SPHB, which was high beta, uh, that and how it was dominating. Look at the relative strength and how this all through January went to the upside, and then that against low volatility stocks. And you can see on a relative basis how terrible they were during January. We're starting to see the reverse now. And again, this is keeping in line with a rotation into defensive sectors. Let's look at a weekly chart on this. SPLV up 1.38% on the week. On the other hand, high beta down 3.77. So big divergence there. Money flowing out of higher beta stocks into lower volatility stocks. So back to the tail of the tape. uh, Two pieces of data came out. First at pre-market ADP data, and jobs added 145K, significantly less than 205 that was expected. We'll get the official non-farm payroll from the government on Friday, but the market's closed, so won't be able to gauge the reaction to it until the following week. Then at 10 o'clock, ISM data, also weak. 10 o'clock. Let's take a look at these yields again, and let's look at a 5-minute chart and see how the market and yields are reacting to this 10 o'clock data that comes out. 3 days in a row here. 10 o'clock data dump shows recession, yields drop. 10 o'clock, that was Monday. 10 o'clock Tuesday, recessionary data, yields drop. 10 o'clock Wednesday, recessionary data, yields drop. Went sideways, didn't continue lower. Just the opposite on the TLT. You'll see at the 10 o'clock how the price spiked up. That's representing, rates going lower, price spiking up on TLT. 10 o'clock Monday, 10 o'clock Tuesday, 10 o'clock Wednesday, then a bigger shakeout, but resumed the trend to the upside before moving sideways. So those 10 o'clock data dumps, when I always record the 10 o'clock price to determine whether the Bulls or the Bears are in charge for the opening 30 minutes. And it's interesting to watch how this spikes right at 10 o'clock when this news hits the headlines. So anyway, we've gone from up 6 out of 8 days, now up 6 out of 9. The last 2 days were consolidations. We're still trending above the 80 EMA and the 21 EMA for the ninth day in a row now. We're split nearly even, 54-46, with 54% favoring. This is the Fed fund futures favoring no raise at the month away Fed meeting. This 4078 support resistance level held on the S&P. In fact, we undercut down to 4072 and rebounded to 4090. We undercut this 330, or we held this 313.68. We undercut something I'm not showing here. That's that key fib, and reclaimed that. So held the resistance level. There are the opening ranges. The sectors, gold and gold stocks, were stronger on the day, but by the end of the day, kind of mixed. So we don't want to have that in there. But the dollar higher, and then energy, staples, utilities, and XLV, which is healthcare, up on the day on the downside. Bond yields, semiconductors, that's tech, IGV, that's tech, XRT retail, slowing economy, TAN, that's solar, high beta, and also XLI down 1.3%. Almost neglected to put that in there. So industrials continuing to the downside. I showed SPHB and SPLV as part of the focus list. So in the portfolio, 5 sells today, and then we bought that TMF, the equivalent of 3 times TLT. Bottom line, continued rotation hits growth leaders hard, and now we need to see if we're going to settle in as this rotation that's taken place within the S&P 500 continues. And again, hitting the growth sectors today. We got stopped on a few things. Let's go through those first. And this is part of the title, Strength Revealed in the Pullback. So let's start with our first sale, FSLR. We're going to note a couple of things. And the downgrade on Monday, we held the 21-day yesterday, which is where we needed to, but today sold off, and all solar sold off today. So pretty hard break of the 21 down to this 200 level, but we got stopped out on that for a small loss. Next up, well, right out of the box, AI was weak again, and that last little piece that we had, we sold that pretty much immediately. And this is this short seller put out the same report a couple weeks ago. It was kind of just ignored then, but this time Barron's picked it up, and you got to go by what the price says. AI has great CEO. This guy's questioning the financials, so the market's given it some weight, down double digits for the second day in a row, and we got stopped on that, which pretty much offset the losses on that, offset the gains on ON. Now we've been using our gap rules on ON. You can see on a 30-minute chart here how this 30 level was extremely important, holding any pullbacks for the last week and a half on this. So after we broke the 30 level, I sold our first half of it. And then I said to the fellas, let's keep an eye on this and see if we rally back up. Is this 30 going to flip from support to resistance? And while we were trying for this half hour, 45 minutes and couldn't get back, then we pulled down, then tried to go up again and started making lower highs. We sold the rest of it and closed it out for a nice gain. From the models of these growth stocks, we know that they shake from time to time. We've got rules for getting back in if this reasserts itself, but we also need the right market included in that. An obvious reentry area would be a pullback to the 21-day moving average. That would get us back in right about where we made our very first buy on the gap up day. So we'll see how this proceeds during the day. Not easy holding these stocks, but we held on to a solid chunk of the gains that we'd accumulated over the last 2 weeks. Next up, AMD, and AMD just kind of had lost its mojo and its relative strength over the last 2 weeks. You can see the relative strength line started to bug me when it undercut, but really from a moving average standpoint, wasn't really doing anything wrong. But this relative strength line move relative to its last move back above the 8 was significantly below the move when it broke up above 100, and then today it broke below the 21-day moving average, as all semiconductors were weak today, with the exception of Rambus. And Rambus is actually our number 2 favorite now. But last week, there was a harsh pull-off in semiconductors. It came back, bounced at the 50-day moving average, did it again today. So let's see where this takes us tomorrow. If we can reclaim the 21-day moving average, which is around 427.50, as I'm setting an alert a little bit above that. And RMBS acting extremely strong. 2 big days above average volume with the breakout. It's holding the breakout. All it did today is pull back to pivot plus 5% and the 8 EMA. This is looking pretty nice. And this is part of strength revealed in the pullback. This one held up great. It was actually positive on the day while growth stocks were getting hit and while AMD was down 3.5%. So this is, just some of the rotation that takes place, and you gotta not ride with a horse that's drowning. Next up, we sold A&D. We went through ON, ARK-K, showing leadership qualities on this Friday breakout above all its moving averages, but just plain and simple gave it back over the last 3 days as we rotated out. Hard move down here below this alert level, and we sold it this morning to get out of that. So those are all the buys and sells. The bottom line is we came in with a 1.43% adjusted volatility adjusted beta. We're leaving the day with 0.95%. We got 40% allocation in bonds, 60% in the S&P 500, and remaining six names that we have: TMDX, ANET, Palo Alto, NVIDIA, and Lulu, and our gold position. Let's take a look at the charts of those before we close out by looking at the strength and weakness of the indexes. So TMDX weak today, but regained the 50-day moving average. We've got a small 1% position on this that we have about a 15% gain on. We got into it back here, but it's pulled back since it's a big gap up on earnings. It's on the thin side, so it trades a little bit wild sometimes, but two false breakouts in 2 of the last 3 days, undercut but closed strong back above the 50-day moving average today. So somebody was buying shares into the close. ANET, very normal pullback here on light volume. This was a little bit abnormal last week. One day reclaimed it. Last 2 days on below average volume. Not thrilled with the relative strength line or the stochastic line, but volume and price basis, this pullback has been considered normal. Palo Alto continues to stay strong, but a false breakout, as we've seen with a bunch of the growth leaders. 2 days of very tight pullback on below average volume. Add a third day into that, still holding the ADMA. This is still a leader in cybersecurity, holding the 21. Still holding NVIDIA. NVIDIA got downgraded, and also Google came out and claimed they've made chips faster than NVIDIA. We'll see about that. Gap down, closed near the high of the day. Volume normal. First break below the ADMA in 3 weeks. Note how strong this uptrend has been. It's bounced twice off the 21-day moving average. Let's see if today's lows hold or if it's going to revisit the 21 again. And Lululemon, we bought this on the volume gap up. It's been actually showing relative strength this week since its volume gap up, especially compared to growth leaders. This is acting just fine. Nothing wrong here. Small 2% position on this. So that's what we've got remaining in the portfolio, in addition to the gold and now the TMF. Let's quickly go through this weekly charts of the spider sectors so we can again reinforce what's been strong and what's been weak this week, as that inflation data has really taken a toll. Start off with basic materials down 1% on the week. Energy, remember we had that production cut, and still up 4% on the week despite a pullback the last 2 days. Communication sector has been holding up just fine. It's positive on the week. This is mostly Meta and Google. The financials, continued weakness, down 1% on the week. Industrials down 3.3%. This is one of the ones that stood out to me. Note the relative strength weakness on the weekly chart too, where the price is just where it was a couple weeks ago. The relative strength line is making new lows ahead of the price. That's a negative. Tech still holding up fine. Remember, this is mostly Apple and Microsoft in XLK. Still down 1.8% on the week, though. Consumer staples, this is where the money's flowing. It's defensive, up 0.8%. Real estate down 1.4. This is one of the sectors we're avoiding. Utilities with the big move up. Again, this is defensive, up 2.4% on the week. Healthcare up 2.9% on the week. This is dominated by United Healthcare and Johnson & Johnson. And Johnson & Johnson was up big today on a talc settlement from all the lawsuits that are out there. But healthcare still, this is a defensive sector that money tends to flow into in recessionary times. And then finally, consumer discretionary. Just the fact that it's saying discretionary means discretionary spending, which discretionary spending goes to the necessities during a recession, not to whatever the extras are. And the reaction to this is down 3% on the week. This is nearly 48% Tesla, Home Depot, and Amazon. So you got to dive a little bit deeper to see what's going on. But you can see the rotation that we've talked about. And again, this rotation all takes place within the S&P 500, which is only down 0.44% on the week. And that's why we're quite happy to make the ballast in our portfolio when the market is in an uptrend, and then add alpha with the growth leaders. And if they can't do it, the growth leaders get cut. So that's going to wrap it. As always, love to hear from you. Remember, why we actively manage is to avoid these bear markets. When the entire market is in a downtrend, we'll be primarily in cash. When there are sectors that are working, that's where we'll focus. If they stop working, we'll get the heck out. All these bear markets occur under the 200-day moving average, which is where we are in small and mid caps. That's the responsibility. That's the blame of that goes to the banking liquidity crisis that's going on, and that's why we're avoiding those areas. And if you're interested in this approach, reach out to me, Don at RevereAsset.com, or my partner Dan Stewart, Dan at RevereAsset.com. The phone is 855 Real Wealth. That's 855-732-5932. Every day you survive in the market is one step closer to the next bull market. Growth stock investing, not easy. Sometimes you get paper cuts. That's why we attempt to keep our losses small. Sometimes things come out of the blue and it's just plain bad luck, but it's part of the game. We don't blame it on anything, but we're completely responsible for the decisions that we make. And if you like this approach and the rules that we have, reach out and discuss it with us. So wrapping up, first reminding you, it's not how much you make in the market, it's how much you can keep. We'll be recording the podcast tomorrow with the market closed on Friday. So tomorrow night, I'll have a Thursday night 21 over 21 list update. And over the weekend, the quarterly client video will go out. And with that, I'll wrap up Wednesday, April 5th. This is Don Vandenbord telling it like it is. Thanks for listening. Have a great day.